Welcome back to Silver and Metal IQ, your front row seat to everything gold, silver, and precious metals. I'm Peter, and today we're diving headfirst into the wild swings in the silver market that are leaving traders stunned and stackers intrigued. If you've been following silver closely, you know the past couple of days have been nothing short of a roller coaster, and we're going to break down exactly what's happening, why it matters, and what it means for the bull run ahead. It was another volatile day for silver. Prices started the session sharply lower, hitting an intraday low of $73.82 after peaking near $79.30 earlier. By the close, silver had partially recovered, ending down only 1.7% at $76.88. On the surface, this looks like just another day of market turbulence, but the truth is far more interesting. That dip is not necessarily a sign of weakness. It's part of a corrective move in a market that is quietly preparing for more upside. What's driving this? Recent reports show that silver, unlike gold, is still under pressure from market mechanics, while gold itself has held strong, even pushing near the critical $4,500 level. This divergence has widened the gold-to-silver ratio to 58.27, which many analysts see as a historic buying opportunity for silver. In short, while some traders panic at the paper market swings, the physical fundamentals are signaling opportunity. Several factors are influencing the market. On the macro side, tensions in Venezuela, geopolitical frictions between China and Japan, and anticipation of the U.S. non-farm payrolls report are all creating volatility. In addition, the Federal Reserve's monetary stance, particularly upcoming leadership changes, adds another layer of uncertainty, keeping traders cautious. Despite these fluctuations, the silver market is testing key support levels, like the 50-day moving average, which has historically acted as a springboard during uptrends. Technical indicators show mixed signals. The Relative Strength Index, RSI, sits at 46, indicating a cooling off after recent gains. The Moving Average Convergence Divergence, MACD, has dipped below its signal line, reinforcing short-term bearish pressure. Yet, silver's ability to recover from its lows by the end of the session suggests the bull trend is far from over. For long-term investors and stackers, this is not a signal to panic. It's a moment to prepare for strategic accumulation. What's particularly intriguing is the role of large players. Reports indicate that billionaires and institutional buyers are actively acquiring physical silver, creating strain in availability. Figures like David Bateman have been quietly stacking, holding onto their positions for ideological reasons, recognizing silver as sound money in an inflationary world. Every ounce purchased by such players tightens the market and reinforces the scarcity story, sending a powerful message to those paying attention. For individual investors, the takeaway is clear. Buy on dips, stack strategically, and recognize that volatility in the paper market doesn't always reflect the underlying strength of the physical market. While silver may move up and down in the charts, physical demand continues to grow, and that's where the real power lies. So, what did I do? I added more to my personal stack, taking advantage of the highs and lows, focusing on coins and dimes that hold long-term value. This is how smart stackers approach volatility, not as a threat, but as an opportunity. Banks in Korea are halting the sales of silver and gold bars amid skyrocketing demand, creating what some are calling a collapse in the commercial market. Reports from multiple Korean sources, including the Korean Minting and Security Printing Corporation and the Korean Gold Exchange, confirm that the supply of gold and silver bars to banks has been suspended. This isn't just a temporary pause. Inventories have run dry, and commercial banks can no longer meet investor demand for these assets. The surge in demand is driven by a mix of geopolitical uncertainty and a flight to safe haven assets, particularly since U.S. President Donald Trump's tariff threats and ongoing global tensions. Gold bars, which had become the most popular investment choice, have been nearly impossible to obtain, pushing investors towards silver bars as a secondary option. However, silver itself is now facing similar supply strains, leading to unprecedented shortages in Korea's retail and commercial markets. Major banks affected by this suspension include KB Kookmin Bank, Shinhan Bank, Woori Bank, and NH Nongyup Bank. While some smaller quantities of 1 kilogram gold bars were still available temporarily, they too have largely disappeared from the market. Even alternative sources or private suppliers are struggling to keep up with demand, leaving investors scrambling. This squeeze highlights a critical lesson for the global precious metals market. When physical supply is constrained, price mechanisms alone cannot stabilize availability. In Korea, the interplay of surging demand, restricted supply, and institutional control has created a bottleneck that mirrors some of the most dramatic historical squeezes in gold and silver markets. For investors watching the West, it's a reminder that even stable markets can face supply shocks under the right conditions. While the US and other countries still have abundant bullion available, trends like this illustrate the importance of staying ahead of the curve, understanding supply chain dynamics, and considering how global disruptions can impact local markets. So, as the Korean silver and gold squeeze unfolds, one thing is clear: physical ownership matters more than ever. Those who act early may secure assets before conditions tighten further, while those waiting could face higher premiums and limited access. Over the past month, we've been witnessing a phenomenon that's fundamentally different from the usual volatility. Delivery figures are showing massive volumes of physical gold and silver being removed from exchanges at the very start of the month, continuing a trend that's been quietly accelerating since 2020. What makes this remarkable is the type of participants involved. Sovereign entities, major financial institutions, and industrial buyers are increasingly dominating the physical market. These are not speculators reacting to short-term price swings. They are methodically positioning for future constraints. Essentially, the game has shifted from paper trading to physical accumulation, and it's happening at a pace that can't be ignored. Why does this matter? Well, the dynamics of the market are changing. Paper prices, driven by futures and leveraged positions, no longer tell the full story. Institutions that were historically associated with suppressing prices are now actively moving metal into their own accounts. This is a strategic, slow-burning process. They aren't trying to crash the market. They are quietly reducing accessible inventory. Think of it as a controlled squeeze. The supply is being drained little by little, and once it reaches critical mass, the market reacts sharply. The mechanics behind these price swings are fascinating. When margins are increased on the COMEX during periods of low liquidity, smaller leveraged traders are forced to liquidate, creating temporary price drops. But here's the twist. The big players, the sovereign buyers, and cash-rich institutions are waiting to pick up that metal at a discount. This cycle repeats, yet instead of weakening the market, it strengthens the position of those with the deep pockets and physical delivery capabilities. The result? Price suppression attempts are no longer effective against buyers who pay cash and take delivery. The market's center of gravity is shifting from paper contracts to tangible physical holdings. And here's something crucial. This isn't a short-term blip. We are witnessing a structural change in how silver and gold are valued and accumulated. Supply chains are tightening, available inventories are shrinking, and the focus of buyers is shifting towards securing real metal rather than chasing quick profits. The volatility you see in prices now is largely a reflection of operational pressures in the system rather than fading demand. Every dip is met with absorption. Every short-term sell-off quickly bought up. And as the market tightens further, we can expect sharper and more abrupt price moves. So, whether you're a stacker or a long-term investor, understanding these underlying forces is critical. The age of paper dominance is fading, and physical control is becoming the defining factor in precious metals. If you're paying attention, the signs are clear. Accumulation now could position you well for what comes next. Over the past few months, the US and global precious metals markets have started to behave very differently. Deliveries from the COMEX and other exchanges are accelerating, and what's unusual is who's taking delivery. Not small investors, but sovereign governments, major institutions, and large industrial buyers. This isn't random, it's methodical. The The strategy is subtle but extremely powerful. By gradually draining the system, these participants avoid shocking the market while steadily reducing accessible inventory. This slow but persistent accumulation creates a physical scarcity that paper prices alone cannot reflect. This has real consequences for everyday buyers and stackers. You've probably noticed rising premiums on coins, bullion, and even pre-1965 junk silver. The reason is simple. Supply is tightening. Refineries can only process so much metal at a time, and when demand spikes, it takes weeks to convert raw silver into coins, rounds, or bars. Large dealers who recognize the pinch are snapping up anything available, often below spot, leaving smaller dealers scrambling. Even once stable sources like 100-ounce bars are becoming scarce because international suppliers are hesitant to ship during periods of tariff uncertainty. In short, access to physical silver is becoming increasingly competitive. Margin mechanics on exchanges like COMEX also play a key role. By raising margin requirements, leveraged traders are forced to liquidate positions when prices move higher, which temporarily pushes prices down. But here's the critical part. These liquidations are quickly absorbed by cash buyers who are taking actual delivery. What we're seeing is a market where speculative paper trading is increasingly disconnected from the real, physical market. The market is being quietly reshaped beneath the surface, and those who understand this shift have a significant advantage. Another factor driving this squeeze is geopolitical and industrial demand. Solar companies, electronics manufacturers, and other industrial consumers are competing for finite silver supply alongside sovereign entities accumulating it for reserves. When you combine industrial demand, long-term investor stacking, and the strategic moves of large governments, you have a perfect storm of supply pressure that could influence pricing for months, if not years. For those of you stacking at home, this means every opportunity to secure physical silver or gold is more critical than ever. The buy-the-dip strategy still works, but timing, reliability of suppliers, and understanding premiums are now more important than ever. This isn't just short-term volatility. It's a fundamental shift toward a market where ownership of physical metal takes precedence over speculation. The first thing to understand is that the paper market and the physical market are moving in very different directions. While leveraged traders in the futures market are being shaken out through margin increases, sovereign entities, major financial institutions, and industrial consumers are quietly stacking physical silver and gold. They aren't reacting to short-term price swings. They're positioning strategically for long-term scarcity. Over the past months, delivery data has shown an extraordinary volume of metals being taken off exchanges, particularly in the first days of each month, signaling that real ownership, not speculation, is now the priority. This trend has accelerated compared to past cycles. Unlike previous spikes where speculative demand dominated, we are now seeing cash buyers standing for delivery, draining the system slowly and deliberately. This gradual accumulation avoids shocking the system, yet steadily reduces accessible inventory. It's a subtle but powerful signal that the dynamics of the silver and gold markets have fundamentally shifted. Price suppression tactics that once worked are increasingly ineffective because the players holding metal are well capitalized, long-term buyers who are outside the margin system entirely. Now let's talk about leverage and margin impacts. In recent weeks, the CME Group raised margin requirements multiple times, sometimes by 30% in thin trading periods. This isn't about market safety. It's a coordinated effort to shake out leveraged traders who don't have the capital to withstand sudden requirements. Many traders are forced to liquidate positions, causing temporary drops in futures prices. But here's the key. These temporary dips are immediately absorbed by major players, governments, large industrial buyers, and cash-rich institutions who take delivery and continue to build their positions. The impact on availability is visible. Physical silver is disappearing at unprecedented speed. Pre-1965 coins, silver eagles, and rounds are becoming harder to source, while premiums rise rapidly. Refineries are processing backlogs from multiple sources, creating a lag in supply. Bars from major global refiners are increasingly difficult to obtain due to tariffs, logistics, and geopolitical pressures. For the first time in recent memory, the U.S. market feels the pressure that previously was seen only in international hotspots. If this trend continues, competition for physical silver will intensify, and access to tangible metals will become a primary driver of price rather than market sentiment alone. So, what does this mean for long-term stackers? Simply put, holding physical silver and gold is now more than just a hedge. It's a strategic move. Volatility may continue to shake paper markets, but those who secure physical metal are protected from short-term disruptions. The market is entering a new phase where scarcity, not speculation, dictates value. Prices may still fluctuate, but the underlying reality is clear. Physical ownership is becoming paramount. Those who understand this shift early will be the ones best positioned when the next wave of market adjustments hits. The key takeaway is clear. The market is no longer just about price swings or speculative trades. Access to physical metal has become the ultimate priority. As deliveries continue to rise and inventory tightens, short-term fluctuations in futures prices are increasingly absorbed by well-capitalized buyers standing for delivery. This is a structural realignment, a shift from paper-driven markets to tangible, real-world scarcity. If you're stacking for long-term security, now is the time to ensure your holdings are protected, diversified, and positioned for an era where supply will increasingly dictate value. We've also seen how margin requirements, leveraged positions, and logistical pressures create temporary dips in price, often shaking out less capitalized traders. But these dips are fleeting, absorbed quickly by those with cash in hand, turning volatility into opportunity for strategic accumulation. Whether it's pre-1965 coins, silver eagles, or rounds, physical silver is becoming increasingly scarce. Bars from major refiners face global supply chain and tariff pressures, making it clear that holding tangible assets is no longer optional. It's essential. As we move forward, investors need to focus on securing physical ownership, understanding market mechanics, and staying alert to geopolitical and financial developments that impact supply. Silver and gold remain more than just investments. They are wealth preservation tools, strategic assets, and a hedge against uncertainty. The real winners in this cycle will be those who act with foresight, patience, and an understanding of the broader structural forces at play. Financial disclaimer: all content provided on Silver&Metal IQ is for informational, educational, and entertainment purposes only. It does not constitute financial advice, investment advice, or a recommendation to buy or sell precious metals. Always conduct your own research and consult with a licensed financial professional before making any investment decisions. Past performance is not indicative of future results. Thank you for sticking with us through this 6-part series. If you found this content valuable, please like, share, and subscribe to Silver&Metal IQ for more expert insights on gold, silver, and the precious metals markets. Stay informed, stay prepared, and keep stacking wisely, because your future wealth depends on the choices you make today.